My dear students, welcome back to our channel. In this video, I will be explaining the Bachelor of Commerce 4th semester subject Income Tax as prescribed by Osmania University and other universities of Telangana. We will go through the important questions and answers one by one. Let's begin with a quick revision. Unit 1. The first important short question is: who is an assessee? In income tax, an assessee is a person who pays or is liable to pay tax to the government. This person can be an individual like you or me, a company, firm, HUF, Hindu undivided family, or even a trust, local authority, etc. Example: Ravi is a salaried employee. Every year, he files his income tax return and pays tax on his salary. Ravi is an assessee. Now suppose Meera runs a business and earns 15 lakhs rupees a year. She also files ITR and pays taxes. Meera is also an assessee. Easy tip to remember: assessee is equal to any person who is assessed for tax. If you pay or file, you are in the tax file. Next important short question is: 2. What is gross total income? Gross total income, GTI, means the total income you earn from all sources before any deductions under sections like 80C, 80D, etc. In short, it is your total earnings before tax benefits. GTI includes income from 1. Salary, like job income. 2. House property, like rent. 3. Business or profession. 4. Capital gains, like profit from selling shares property. 5. Other sources, like bank interest, gifts. Example: Riya earns 5 lakhs rupees from salary, 1 lakh rupee rent from house, 20,000 rupee interest from FD. So, gross total income is equal to 5 lakhs rupees plus 1 lakh rupees plus 20,000 rupees is equal to 6 lakhs 20,000 rupees. Easy tip to remember: GTI is equal to grand total income from all 5 heads. Before 80C it's GTI. Next important short question is: 3. What is agricultural income? Agricultural income means the money earned from farming activities. In India, this income is not taxed under the Income Tax Act. What counts as agricultural income? 1. Income from growing crops like wheat, rice, sugarcane, etc. 2. Rent from agricultural land. 3. Selling produce grown on your land. 4. Income from a farm building used for storing crops or tools. Example: Amit owns a farm in Punjab. He grows and sells wheat and earns 3 lakhs rupees in a year. This 3 lakhs rupees is agricultural income and is fully tax-free. Important note: if someone earns both agricultural and non-agricultural income, the tax might apply differently, called partial integration. Easy tip to remember: farming money is tax-free honey. Because India supports farmers, this income stays out of tax net. Next important short question is: 4. Who is a person in income tax? In income tax, a person is not just one human being. It includes anyone or any group that can earn income and pay tax. Types of persons under income tax: 1. Individual like Ravi, a salaried employee. 2. HUF, Hindu undivided family, like a family business. 3. Company like Tata or Infosys. 4. Firm partnership like Sharma & Co. 5. Association of persons, AOP, group earning income together. 6. Body of individuals, BOI, similar to AOP but only individuals. 7. Local authority, like a municipal corporation. 8. Artificial juridical person, like a trust or temple. Example: if a college earns rental income from a hall it owns, it is also a person under tax law. Easy tip to remember. Person is equal to anyone who can earn and pay tax. Not just people, even groups and organizations. Next important short question is: 5 basic conditions for individual residential status. To determine your residential status, whether you are a resident or non-resident, the Income Tax Act uses two main conditions. 1. Condition 1. You must have stayed in India for at least 182 days in the previous year, April to March. 2. Condition 2. If you didn't meet Condition 1, but stayed in India for at least 60 days in the previous year and 365 days in the last 4 years, you are considered a resident. Example: if Ravi stays in India for 200 days in the year, he is a resident. If Maya stays for only 50 days in India but has stayed 350 days in the last 4 years, she is still a non-resident. Tip to remember: 182 days or 60 plus 365. Stay in India for these periods to be a resident. Next important short question is: 6. What is the previous year in income tax? The previous year, also called financial year, is the year in which a person earns income and pays taxes. It runs from 1st April to 31st March. Why is it important? Income earned between 1st April and 31st March is considered during the assessment of income tax. Taxes are calculated on the income earned in the previous year, and the tax is assessed and paid in the assessment year, which is the year after the previous year. Example: previous year, if you earn 5 lakhs rupees from 1st April 2024 to 31st March 2025, the previous year is 2024 to 2025. Assessment year: the tax for this income will be assessed in 2025 to 2026. Easy tip to remember: previous year is equal to 1st April to 31st March. Income earned, tax year assessed. Next important short question is: 7. What is total income? Total income is the final income after adding up all your earnings from different sources and then subtracting any tax deductions. It is the income on which you pay tax. How is total income calculated? 1. Add all sources of income like salary, rent from property, interest from bank, profit from business, etc. 2. Subtract deductions available under sections like ATC, ATD, etc., like savings in PPF, insurance premiums, etc. Example: salary 6 lakhs rupees, rental income 1 lakh rupees, bank interest 20,000 rupees, deductions ATC 1,50,000 rupees. So, total income is equal to 6 lakhs rupees plus 1 lakh rupees plus 20,000 rupee minus 1,50,000 rupees is equal to 5,70,000 rupees. Easy tip to remember: total income is equal to earnings deductions. Tax is paid on the total income. Next Unit 1 Important Long Questions. First important long question is: 1. Write about canons of taxation. The canons of taxation refer to the principles or guidelines that make the tax system fair, efficient, and effective. These canons were first explained by the famous economist Adam Smith in his book, The Wealth of Nations. There are 4 main canons of taxation, and understanding them helps you see how a good tax system works. 1. Canon of equality, equity. This principle says that taxes should be fair and proportionate to the taxpayer's ability to pay. The richer should pay more and the poorer should pay less. Example: if a person earns 10 lakh rupees, they should pay a higher tax rate than someone earning 3 lakh rupees. 2. Canon of certainty. This principle suggests that the amount of tax, the time of payment, and the method of payment should all be clear and certain. There should be no confusion about taxes. Example: you should know exactly how much tax you owe by the end of the financial year, and the government should tell you when and how to pay it. 3. Canon of convenience. Taxes should be easy to collect and should be convenient for taxpayers to pay. The method of collection should suit the taxpayer's situation. Example: salaried employees have taxes automatically deducted from their salary, TDS, which is convenient for both the government and the taxpayer. 4. Canon of economy. This principle says that the cost of collecting the tax should be low. The government should not spend too much money on collecting taxes. Example: if the government spends 2 rupee to collect 5 rupees, it's not efficient. Instead, they should aim to collect 5 rupees with minimal cost. Tip to remember: every clever citizen pays economically. E for equality. C for certainty. C for convenience. P for economy. Next important long question is: 2. Write any 5 concepts of income tax. 5 key concepts of income tax. 1. Income. Income is the money or wealth that an individual or business earns. It includes earnings from various sources like salary, business profits, rental income, and interest. Example: Ravi earns 6 lakhs rupees from his job. Meera earns 1,50,000 rupees from her shop. These are their incomes. 2. Assessment year, A. The assessment year is the year in which your income is assessed and tax is calculated. It's the year after the previous year. For example, for income earned in the financial year 2024 to 2025, the assessment year will be 2025 to 2026. Example: income earned in 2024 to 2025 is assessed in 2025 to 2026. 3. Taxable income. Taxable income is the income on which tax is calculated. It's the total income after deductions, like savings in PPF or insurance premiums under sections like 80C. Example: gross income is equal to 7 lakhs rupees. Deductions is equal to 1,50,000 rupees. Taxable income is equal to 7 lakhs rupees to 1,50,000 rupees is equal to 5,50,000 rupees. 4. Tax deducted at source, TDS. TDS is the money deducted by the employer or payer before giving you your income. It's deducted at a certain percentage and paid to the government. Example: if Ravi earns 10,000 rupee per month, the employer may deduct 1,000 rupees as TDS, so Ravi gets 9,000 rupees. The 1,000 rupee goes directly to the government. 5. Deductions under Section 80C. Section 80C allows taxpayers to reduce their taxable income by investing in certain financial products like PPF, life insurance premiums, and National Savings Certificates, NSC. Example: if Amit invests 1,50,000 rupees in PPF, this amount is deducted from his taxable income under Section 80C, reducing the amount of income on which he needs to pay tax. Tip to remember: I is equal to income. A is equal to assessment year. TI is equal to taxable income. TDS is equal to tax deducted at source. The ATC is equal to deductions under section ATC. Next important long question is 3. Explain various incomes which do not form part of total income. Incomes not included in total income. In the Income Tax Act, certain incomes are exempt from tax, meaning they do not form part of the total income of an individual. Let's look at some common examples. 1. Agricultural income. Income earned from agricultural activities is exempt from tax. This includes money earned from farming, selling crops, or renting out agricultural land. Example: Ravi earns 2 lakhs rupees from growing crops on his farm. This 2 lakhs rupee will not be taxed. 2. Income from gifts. If you receive a gift from a relative or friend, it is usually not taxable, provided the gift amount is below 50,000 rupees in a year. Certain gifts like inheritance, property or money passed down from a deceased person are also exempt. Example: Meera gets 40,000 rupees as a birthday gift from her aunt. This is not taxable. 3. Income from mutual fund dividends. Dividends received from mutual funds or shares are exempt from tax up to a certain limit, provided they are within the prescribed limits. Example: If you receive a dividend of 20,000 rupees from your mutual fund investment, it may be exempt from tax. 4. Income from life insurance policies. The amount you receive from a life insurance policy, whether it is matured amount or the sum insured, is not taxable as long as the policy meets the conditions laid out by the government. Example: If Ravi receives 5 lakhs rupees from his life insurance policy, this income will not be taxed. 5. Provident Fund, PF, and gratuity. Contributions to the Provident Fund, PF, and payments from the gratuity fund are generally exempt from tax under certain conditions. This is a form of long-term saving for retirement. Example: Amit's employer deposits 2 lakhs rupees in his PF account. This amount will not be included in his taxable income. Easy tip to remember: AGI, gifts, dividends, insurance and PF, no tax, only relax. These are some of the major types of income that do not form part of your total taxable income. Next important long question is 4. Explain about the income tax rules to determine the residential status of an individual assessee. Residential status of an individual assessee. The residential status of an individual determines how much tax they have to pay. In India, the Income Tax Act provides specific rules to decide whether an individual is a resident or a non-resident. Here's how it works. 1. Basic criteria for residential status. An individual can be classified as a resident or non-resident based on the number of days they stay in India during the previous year, FY. 2. The 182 days rule, resident. If an individual stays in India for at least 182 days in a previous year, they are considered a resident. In this case, they have to pay tax on their global income earned in India and abroad. Example: Ravi stays in India for 200 days in the year. Ravi will be considered a resident for that year. 3. The 60 days rule, resident. If an individual stays in India for 60 days or more during the previous year and 365 days or more in the past 4 years, they will be considered a resident. However, the 60 days rule is relaxed for Indian citizens who are working abroad or Indian citizens on foreign duty. In such cases, the individual must stay 182 days or more in India in the previous year. Example: Priya stayed in India for 50 days but has stayed 400 days in the past 4 years. Priya is still a resident. 4. Non-resident NR. If an individual does not meet the 182 days rule, they will be classified as a non-resident. Non-residents are only taxed on their income earned in India. Example: John stayed in India for only 120 days. John will be a non-resident and only pay tax on income from India. Easy tip to remember: 182 days or 60 plus 365 resident, else non-resident. Resident, stay for 182 days or 60 plus 365 days. Non-resident, stay less than 182 days. These rules help the government decide how much tax you should pay based on your stay in India. Next important long question is: 5. Calculate tax liability for the current assessment year in the following cases. A. Agricultural income 3,000 and non-agricultural income 78,000. B. Agricultural income of Mr. Kripasagar 2,75,000 and non-agricultural income 95,000. C. Agricultural income of SMT Rama Devi 1 lakh and non-agricultural income 5 lakhs. D. Agricultural income of Mr. Hari Kishan 60,000 and non-agricultural income 2,56,000. Let's calculate the tax liability for each case. Step by step. Agricultural income is exempt from tax, but it still impacts how much you pay on your non-agricultural income. Here's a step-by-step approach. 1. Case: A. Agricultural income 3,000 rupees and non-agricultural income 78,000 rupees. Agricultural income is equal to 3,000 rupees exempt. Non-agricultural income is equal to 78,000 rupees. Since agricultural income is below 5,000 rupees, there is no need for special tax calculation. The non-agricultural income is taxed as normal. Taxable income is equal to 78,000 rupees. Tax. For income up to 2,50,000 rupees, no tax. So, total tax is equal to 0 rupees. 2. Case: B. Agricultural income 2,75,000 rupees and non-agricultural income 95,000 rupees. Agricultural income is equal to 2,75,000 rupees exempt. Non-agricultural income is equal to 95,000 rupees. Here, agricultural income is more than 5,000 rupees, so it will impact the tax calculation on non-agricultural income. Taxable income is equal to 95,000 rupees. Since agricultural income is large, the total agricultural income plus non-agricultural income must be considered for the tax slab. Total income is equal to 2,75,000 rupees plus 95,000 rupees is equal to 3,70,000 rupees. Agricultural income does not attract tax, but it helps decide the tax slab. Since 3,70,000 rupees is above 2,50,000 rupees, the income is taxed. Tax. First 2,50,000 rupees, no tax. Remaining 1,20,000 rupees, 5% of 1,20,000 rupees is equal to 6,000 rupees. So, total tax is equal to 6,000 rupees. 3. Case: See agricultural income 1 lakh rupees and non-agricultural income 5 lakhs rupees. Agricultural income is equal to 1 lakh rupees exempt. Non-agricultural income is equal to 5 lakhs rupees. Here, agricultural income is significant, so it will affect the tax calculation. Let's check the total. Taxable income is equal to 5 lakhs rupees. Total income is equal to 1 lakh rupees, agricultural, plus 5 lakhs rupees, non-agricultural, is equal to 6 lakhs rupees. Now, Since agricultural income exceeds 5,000 rupees, it affects the tax on the non-agricultural income. Tax calculation. First, 2,50,000 rupees, no tax. 2,50,000 rupee to 5,00,000 rupees, 5% of 2,50,000 rupees is equal to 12,500 rupees. 5,00,000 rupee to 6,00,000 rupees, 20% of 1,00,000 rupees is equal to 20,000 rupees. Total tax is equal to 12,500 rupees plus 20,000 rupees is equal to 32,500 rupees. 4. Case, the agricultural income 60,000 rupees and non-agricultural income 2,56,000 rupees. Agricultural income is equal to 60,000 rupees exempt. Non-agricultural income is equal to 2,56,000 rupees. Since agricultural income is more than 5,000 rupees, it impacts the tax calculation. Taxable income is equal to 2,56,000 rupees. Total income is equal to 60,000 rupees, agricultural, plus 2,56,000 rupees, non-agricultural, is equal to 3,16,000 rupees. Tax is calculated as: first, 2,50,000 rupees, no tax. 2,50,000 rupee to 3,16,000 rupees, 5% of 66,000 rupees is equal to 3,300 rupees. Total tax is equal to 3,300 rupees. Quick recap to remember. 1. Agricultural income less than or equal to 5,000 rupees, no special tax calculation needed. 2. Agricultural income 5,000 rupees, affects the slab on non-agricultural income. 3. Tax slabs. Up to 2,50,000 rupees, no tax. 2,50,001 rupee to 5,00,000 rupees, 5%. 5,00,001 rupee to 10,00,000 rupees, 20%. Above 10,00,000 rupees, 30%. I hope this clears up how to calculate tax for agricultural and non-agricultural income. Next important long question is: 6. Shri A. Chalapati submitted the following particulars for the previous year relevant to the current assessment year. Compute the tax liability. Gross total income 16,67,498 rupees. Total deductions from gross total income US 81,20,000 rupees. Tax deduction at source to $10,000 rupees. Advanced tax 1,22,000 rupees. Let's go step by step and calculate the tax liability for Shri A. Chalapati using the given details. I will break it down simply and explain in easy to understand terms. Given information. Gross total income is equal to 16,67,498 rupees. Deductions under Section 80 is equal to 1,20,000 rupees. TDS, tax deducted at source, is equal to 2,10,000 rupees. Advance tax paid is equal to 1,22,000 rupees. Step 1. Calculate the taxable income. To calculate taxable income, we need to subtract the deductions from the gross total income. Taxable income is equal to gross total income minus deductions under Section 80. Taxable income is equal to 16,67,498 rupee minus 1,20,000 rupees is equal to 15,47,498 rupees. Step 2. Apply the tax slabs to calculate the tax. Now, let's calculate the tax on this taxable income using the current tax slabs for an individual below 60 years of age. Tax slabs. Up to 2,50,000 rupees, no tax. 2,50,001 rupee to 5,00,000 rupees, 5%. 5,00,001 rupee to 10,00,000 rupees, 20%. Above 10,00,000 rupees, 30%. Tax calculation. 1. Up to 2,50,000 rupees. No tax. 2. From 2,50,001 rupee to 5 lakhs rupees. 5% of 2,50,000 rupees is equal to 12,500 rupees. 3. From 5 lakhs and 1 rupee to 10 lakhs rupees. 20% of 5 lakhs rupees is equal to 1 lakh rupees. 4. From 10 lakhs and 1 rupee to 15 lakhs 47,498 rupees. 30% of 5 lakhs 47,498 rupees is equal to 1 lakh 64,249 rupees and 40 paise. Step 3. Add the tax. Total tax is equal to 12,500 rupees from 2,50,000 rupee to 5 lakhs rupees plus 1 lakh rupees, from 5 lakhs rupee to 10 lakhs rupees plus 1 lakh 64,249 rupees and 40 paise, from 10 lakhs rupee to 15 lakhs 47,498 rupees. Total tax is equal to 12,500 rupees plus 1 lakh rupees plus 1 lakh 64,249 rupees and 40 paise is equal to 2 lakhs 76,749 rupees and 40 paise. Step 4. Apply rebate for TDS and advance tax. Now, let's adjust the tax liability by subtracting the TDS and advance tax already paid. TDS is equal to 2,10,000 rupees. Advance tax is equal to 1,22,000 rupees. Total paid tax is equal to 2,10,000 rupees plus 1,22,000 rupees is equal to 3,32,000 rupees. Step 5. Calculate the final tax payable or refund. Total tax payable is equal to total tax minus total paid tax. Total tax payable is equal to 2,76,749 rupees and 40 paise minus 3,32,000 rupees is equal to refund of 55,250 rupees and 60 paise. Conclusion. Tax payable 0 rupees because the TDS and advance tax paid exceed the total tax liability. Refund 55,250 rupees and 60 paise will be refunded to Shri A. Chalapati. Quick tip to remember. Gross total income deductions is equal to taxable income. Apply tax slabs to the taxable income. Subtract TDS and advance tax already paid. The remaining amount is either the tax payable or refund. Next important long question is 7. Mr. Umesh Rathod had the following incomes during the previous year ended 31st March 2021. You're required to compute his total income and tax liability if his residential status is resident. I. Salary received in India 4,25,000 rupees. 2. Income from business 11,75,000 rupees. 3. Income occurred in South Africa but received in India 1,90,000 rupees. 4. Interest on saving accounts in Lucky Bank Limited 52,000 rupees. V. Income from house property in India 1,30,000 rupees. Let's calculate Mr. Umesh Rathod's total income and tax liability for the previous year ended 31st March 2021 step by step. Since his residential status is resident, he will be taxed on his global income, meaning all the income he earned, whether in India or abroad, will be included in his total income. Step 1. Calculate total income. 1. Salary received in India is equal to 4,25,000 rupees. Since Mr. Umesh is a resident, the salary received in India will be fully taxable. 2. Income from business is equal to 11,75,000 rupees. This income is from business activities, and since it was earned in India, it will also be fully taxable. 3. Income earned in South Africa but received in India is equal to 1,90,000 rupees. Income earned outside India is taxable in India if it is received in India. Since Mr. Umesh received this income in India, it will also be fully taxable. 4. Interest on savings accounts in Lucky Bank Limited is equal to 52,000 rupees. Interest income from savings accounts is taxable. Since the interest was earned in an Indian bank, it will be taxed in India. Income from house property in India is equal to 1,30,000 rupees. Income from house property in India is taxable in India. So, this will be fully taxable. Step 2. Total income. Now, let's add all the income. Salary is equal to 4,25,000 rupees. Income from business is equal to 11,75,000 rupees. Income earned in South Africa, received in India, is equal to 1,90,000 rupees. Interest from savings is equal to 52,000 rupees. Income from house property is equal to 1,30,000 rupees. Total income is equal to 4,25,000 rupees plus 11,75,000 rupees plus 1,90,000 rupees plus 52,000 rupees plus 1,30,000 rupees. Total income is equal to 19,72,000 rupees. Step 3. Tax calculation. Now, let's calculate the tax liability based on the tax slabs for a resident individual below 60 years of age. Tax slabs for FY 2020-21, assessment year 2021-22. Up to 2,50,000 rupees, no tax. 2,50,001 rupee to 5 lakhs rupees, 5%. 5 lakhs and 1 rupee to 10 lakhs rupees, 20%. Above 10 lakhs rupees, 30%. Tax calculation. 1. First 2,50,000 rupees, no tax. 2. From 2,50,001 rupee to 5 lakhs rupees, 2,50,000 rupees. Tax is equal to 5% of 2,50,000 rupees is equal to 12,500 rupees. 3. From 5 lakhs and 1 rupee to 10 lakhs rupees, 5 lakhs rupees. Tax is equal to 20% of 5 lakhs rupees is equal to 1 lakh rupees. 4. From 10 lakhs and 1 rupee to 19 lakhs 72,000 rupees, 9 lakhs 72,000 rupees. Tax is equal to 30% of 9 lakhs 72,000 rupees is equal to 2 lakhs 91,600 rupees. Step 4. Total tax. Now, add up the taxes from each slab. Total tax is equal to 12,500 rupees plus 1 lakh rupees plus 2 lakhs 91,600 rupees. Total tax is equal to 4 lakhs 4,100 rupees. Step 5. Conclusion. Mr. Umesh Rathod's total income is 19,72,000 rupees. The tax liability for the current assessment year is 4,04,100 rupees. Quick tip to remember. 1. Global income is taxable for residents. 2. Tax slabs. Up to 2,50,000 rupees, no tax. 2,50,001 rupees to 5 lakhs rupees, 5%. 5 lakhs and 1 rupees to 10 lakhs rupees, 20%. Above 10 lakhs rupees, 30%. This is how you can calculate the total income and tax liability for a resident individual. I hope you understand easily each question. All the best students for your upcoming exam. For other subject quick revision. Important questions. Previous question papers. And syllabus. Links are available in description. Check out once. Thank you for watching. Like and share this video with your friends.